Hi, I'm Kevin McPartland, Head of Market Structure and Technology Research at Coalition Greenwich. I'm really excited to be here at CME Group in their New York City headquarters down in Battery Park with Tim McCourt, who runs financial and OTC products. So Tim, thanks for having me.
Yeah, thanks for being here, Kevin.
So much to talk about. So you just stepped in the last couple of months to run financial and OTC products, which is a lot at CME. So can you tell us what exactly do you do? What does that include, and what are you focused on?
For sure, Kevin. So recently, back in June, I took over as Global Head of Financial and OTC Products at CME. And here at CME, that includes our interest rate futures and options complex, our equities complex, as well as our foreign exchange, both EBS as well as futures and options, broker tech, OTC clearing, and cryptocurrencies. So quite a wide remit here at CME. I also like to describe them as sort of think of it as the financial products, the ones that are more financially settled, the non-physical products at CME. And there's a lot of synergies between these markets. So it's been a lot of fun getting to learn some of the new markets in my remit. And it's quite the time for the market. A lot going on, a lot of uncertainty. And it's great to be given the additional opportunity here at CME.
I'm sure. So futures, swaps, cash, like everything is under.
That's correct. So all various interrelated products. The thing that's interesting to me is when you look at the product choice at CME, it's really the customers and our market participants are facing, do I trade this on swaps? Do I trade this on futures? What do I do in options? What do I do in the cash markets? And the great thing this day at CME is you can do all of that risk management here at CME. And that's only becoming more and more important when we look at the uncertainty that's manifesting in the market. Every year seems to be bringing new uncertainties, new challenges to the market, and being able to manage and trade and clear all of your risk at one exchange at CME is a great benefit to the marketplace and to our participants.
Yeah, no, the mix is certainly a rarity sort of in the global capital markets. So before we jump into the weeds, let's step back for a minute. So it looks like we both started our career at JP Morgan a long time ago now, but maybe if you can take us from how you got there, how you started at JP, and what brought you ultimately to where you are now.
Certainly, it's been an amazing ride, on my career here in the financial industry. As you said, I started at JP Morgan back in 2000, where I eventually was an equity index swap trader. And then from there, I went on to RBS, Royal Bank of Scotland. So my background before joining the exchange was really in equity index trading, a longtime equity index swap trader, Delta One trader. And back in 2013, a little over 10 and a half years ago, I made the move to CME. At the time, I thought a very compelling opportunity for myself. When you think about what was going on in the early 2010s with Dodd-Frank and a lot of movement to centrally clearing, to the exchange, on exchange, OTC was, maybe a little bit uncertain about its future. So for me, it was compelling to move to the exchange where all of these transformations were happening. Going from being a participant in the market to being able to be an employee at CME and a leader about how the market was evolving to these ever-increasing risk management needs was something that I found really compelling. And it's been a great career for me here at CME. I recently joined the management team back in 2022, and then with the expanded remit we just talked about. It's also interesting when I think about it just personally, when I took over the FX business and joined the management team back in 2022, that was right when the Russia invasion of Ukraine was happening, and that's when I took over FX. So sort of right into the deep end on that. And then when we look at what's gone on here this year in the rates market, we have SVB earlier this year. We have a tremendous amount of rate movement all across the curve throughout the year. So it's also been a very interesting time for myself and the team as I've taken over these additional product lines. And I'm very excited not only about what we can do from our side of the exchange, but also continuing to work with clients to figure out how can we better serve their risk management needs in this ever evolving, uncertain time.
Yeah, that progression is fascinating from effectively trading the products to now over the last number of years building those products and making them more accessible.
Former colleagues and even current colleagues ask me about what do I find most interesting about moving from the trading side to the exchange side. And I really describe it as, to me, it is fascinating to go from being a participant in the market to effectively operating the market. And it's a very different vantage point. You use a lot of the same acumen and skills that you've acquired over our decades in the marketplace, but you apply them differently to unlock that creativity, to build that momentum around innovative risk management tools and really work with clients to figure out what's next. How can we better and continue to better serve your risk management needs? So that's been really interesting and really exciting. And I'm really looking forward to what the next few chapters at CME have in store as well.
Sure. And as someone who's made a career in market structure, I agree. Like just how the markets function and helping them to evolve is absolutely fascinating. So great transition. So you cover a lot of things. So we're going to see how much we can get through in the time that we have. So we'll start off with fixed income, which is where I spend a lot of my time. Why don't we start with clearing? That seems to be top of mind, particularly on the cash and repo side. As you mentioned, CME, a big clearer as well, although not cash products, at least not now. Can you talk a little bit about your thoughts on clearing, cash, repo, CME's role in the whole evolution?
Certainly, and I think before we get into sort of the clearing question, I think it's also just worth spending a minute on when we take a step back and look at what's going on in the U.S. Treasury space more broadly. We're seeing tremendous amount of activity and risk transfer in the futures and options complex here at CME. This year, we're doing over 5.4 million contracts per day in our Treasury complex. We just recently surpassed the 21 million contract for open interest, which is astounding. I mean, these are record level setting benchmarks that we're seeing in the backdrop of this rate environment. And then you couple that with the ability to trade treasuries, SOFR, options, and even with the introduction of T-bills and esters, outside the U.S., the risk transfer velocity is only continuing to increase here at CME. So I think when we look at the questions around clearing and market structure, they're certainly interesting, but from our perspective, there are a few things that we have to balance when looking at the broader clearing question for Treasury and repo. One is you certainly can't deny the benefits of clearing, mitigating counterparty risk, increasing transparency, and certainly the market structure benefits that central limit order book trading adds to the price discovery process or increases that transparency are all great benefits. Certainly we believe in the central cleared model. We've been in the clearing business for over a century here at CME. But when we look at what does it mean for market structure, it is important that market participants have choice about market structure. When we talk about mandates aren't a one-size-fits-all approach. It's something that we have to think about if it's going to be introduced. How is it going to be received by the market participants? How can we work with market participants to understand what their market structure preferences are? What do they want the market structure to evolve into? So we're continuing to work with clients to figure out if clearing makes sense. But it is important that choice of market structure, I think, is something that is important for this community. And when we look at what the benefits that central clearing provide, it's also important to note that unlike, say, when we looked at OTC mandates or OTC clearing, there was a tremendous amount of inefficiencies and risk that really needed to be specifically addressed in the wake of the global financial crisis and what Dodd-Frank addressed. But when we look at the Treasury market and the repo market, a lot of those efficiencies and those capital efficiencies that are so important to clients are already being tapped into. We also look at our recent announcement that's, with FIC and the cross margining that's coming online in January of next year. That will increase our capital efficiencies, but we already offer portfolio margining between futures and cleared interest rate swaps. There's a lot of efficiencies already there. So it's important to remind people you don't need the mandate to tap into those efficiencies, but it's certainly a topic that is increasing in our conversations with clients, and we'll continue to work with them to figure out what makes sense.
Yeah, I agree, right? It's a return on investment discussion here more than we have to do this for the safety of the marketplace. I think most in the market agree with that, and the Treasury market now trading routinely over $1 trillion a day tells you that that's a well-functioning market, at least from our perspective. So futures and cash, you do both of them. A lot of talk about the basis trade. Obviously, that whole trade can happen here. What do you think is that? I think some on the regulatory side see it as this huge risk to the system. The market participants remind everybody that this is how we keep prices in line. So sort of where are you and CME on this whole debate?
Yeah, it's a great question. Certainly the basis trade is getting a lot of coverage these days. But I think it's important to look at the basis trade, not even just in fixed income or in the interest rate environment. This is a functional feature of markets for keeping them in line. The cash markets and future markets across a lot of the asset classes are heavily interrelated, and that basis trade keeps these markets arbitrage free. It keeps them in line in a way that is beneficial for risk transfer, for liquidity provision, for that general risk management in these markets. But when we look at the Treasury basis trade, I think it's maybe inviting a lot of memories around the post-global financial crisis or the dash for cash in 2020. But I think it's important to understand this is a very different backdrop that we're seeing today. If you look at 2020, I think when the regulators are using that as a point of reference for pointing out some of their concerns around the basis trade, it was very different. It was the pandemic. I think a lot of people were expecting, if you remember, people were forecasting GDP to come in, 25, 30%. That's certainly not what's happened ex post the pandemic. And then you look at the hedge fund community itself, I think the leverage in that community is also very different than what we saw in the financial crisis or post-financial crisis. So what I mean by that is let's look at how the Treasury market has grown the last few years. We look at the commitment of traders reports that I think the regulators look to, and they see some hedge funds carrying that short open interest, and that is maybe what they point to for saying, is there a concern here or is there something we should talk about? But if you look at that, you have to look at it proportionately. So if you look at how the debt has increased, to say 10 trillion, right? We're growing by 10 trillion. And then you look at the level of marketable debt in the US market, that ratio isn't necessarily growing at the same place. It's not like that short open interest in that community is growing at the same rate. It's actually growing at a slower rate. So you have to look at the totality of what's going on. And to us, it's much more important that the basis remain a functional tool to keep that market risk arbitrage free and to keep those prices in line so people can manage their risk across the various interrelated liquidity pools. So it's something that we continue to watch, but it's also important to note that on the future side here at CME, we maintain our margins independently. The clearinghouse is always adjusting them. So even some of the comments around margins or credit on the cash side, it's always important to remember the future side is independent with respect to how we set and collect initial end variation margin.
Right, and I think great point, right, is that the margin and the leverage you get from futures is very different from how hedge funds can access leverage to sort of amplify their positions, right?
That's right. There's just structurally difference in how you can access credit on the cash side versus the initial margin and the capital efficiencies you get on the future side. They're very different and they're treated very differently. And I think sometimes it's important for market participants and regulators to remember the different regimes that these products trade under.
So lastly, on fixed income, we have talked for 2 minutes about LIBOR. Credit where it's due, the transition CME did from the Eurodollar contract to the SOFR contract was incredible. The charts went exactly how they were supposed to. One went down while the other went up, and now your open interest in SOFR futures is continues to grow. Sort of what's left from the LIBOR transition? Is it over and we're done with and moving on? Sort of what are the thoughts there and what's next?
Yeah, it's certainly been interesting to finally have that story come to an end. It's been a multi-year, almost decade-long process for the industry. It was great to see our clients, the industry participants, the regulators all come together to coalesce around making sure that transition went as smoothly as possible. I think certainly fair to say exceed our expectations and how well it went. And to your point, Kevin, when we look at the SOFR volumes and open interest, I think open interest in that complex now is over 56 million contracts, trading a tremendous amount on the futures and options side every day, where that's about 30% over the best Eurodollar year previously. So the fact that it's not only transitioned, but it's substantively grown in this environment, in this usefulness, as the market participants continue to focus on risk management across futures and options, it's really been exciting to watch. But the way I think about it is this is really the start of the SOFR story, not the end. And what I mean by that is think about how many chances does an industry have to really get another bite at the apple for market structure. We have all these lessons that we learned from the last 4 decades in the LIBOR-based ecosystem that now we get to revisit through SOFR. We have the introduction of CME Term SOFR. We have licensing around that's being used in OTC products, is being used by commercial end users. We have SOFR futures, SOFR options. We have spreads between the various products. People are looking at SOFRs versus Treasury, SOFRs versus Ester, now SOFR versus T-bill. So you have this opportunity to build this new ecosystem over the next several decades with the benefit of all this hindsight and lessons learned. And that doesn't happen every day in this industry. So the fact that we can now focus on the future versus the migration to SOFR is something that myself and the team, and frankly the marketplace, is super excited about.
Absolutely, the future, no pun intended. And the macro backdrop is in some ways been perfect, right? There's a focus on the short end of the curve, and then some certainty around the LIBOR transition. There is certainty now, and so financial institutions and users they're all in and they're ready to move forward, which is fantastic. Okay, so FX. You own EBS, trade cash. You do FX OTC. You do FX futures. So what's the focus? What's the growth there? Our research points to a lot of focus on clearing broadly in FX and sort of how that will evolve. That was not included in Dodd-Frank all those years ago, but today we're getting there with uncleared margin requirements, it seems. So what's the story in FX? Where are you focused there?
Yeah, I think one thing that I find interesting is taking over FX and now with the expanded remit to the spot trading on EBS is CME is uniquely positioned on this front as one of the very few, if not only institution that has the robust futures and options, where the recent reports are suggesting it, and putting out there what we've known for a long time, that futures for FX at CME are a leading price indicator in terms of the formation and the price discovery process. And when you couple that with the preeminent FX source from EBS in terms of market data, the CLOB, the NDF capabilities, putting all of those together to offer one holistic FX risk management venue to the marketplace is uniquely compelling, and we're very excited about continuing to innovate in that space. Over the last several years, we've been focused on integrating broker tech as well as EBS onto our Globex electronic trading platform. That's been a major focus of us, and now that's also behind us, so we can move from a period of integration to now a period of innovation in these markets. We still see a tremendous amount of value in unlocking cash and futures trading side by side, looking at unlocking those capital efficiencies, answering and engaging around the clearing questions for things like FX. What does it mean for NDFs? What does it mean for spot? What does it mean for forwards? And then you couple that with a very robust futures and options franchise at CME. It's a very powerful combination. And I think to your point, with UMR becoming more and more important and the access to capital becoming more and more expensive in this environment, unlocking those capital efficiencies is only going to become more important to clients, and certainly CME is the natural home to do so with the totality of all those foreign exchange assets that we have.
Right, because we don't have mandates like we do for interest rate swaps. So are you hearing from your clients and your clients' clients that they are actually starting to change their behavior now?
I think slow and steady, but we are starting to see it because those costs of capital, so to speak, are now being pushed down to the individual trading desk level. That practitioner, that decision maker, that's becoming an increasing cost of goods sold. So to think about it when you think about their risk management strategy, and then when you think about maybe the commercial end user or the consumer product companies out there or the multinationals that have the various inbound currency streams of income, they're also getting more attuned that they need to hedge that. When you think about the interest rate differentials that have emerged across the globe in light of the disparate central bank policies, with the return of FX volatility last year, even though it subsided a little bit this year, sort of the price of not hedging your currency exposures is becoming more and more expensive. And that's going to impact corporates' bottom lines. If you're a trading firm or an asset manager, you need to be more precise in hedging that, whether you can do it forward out the curve at the onset, or you can use futures to hedge or complement some of your spot-based trading. Folks are just getting more attuned that you can't sort of like set it and forget it in the FX market that you could a few years ago, not with this interest rate environment, and certainly not with the volatility that we've seen in the FX markets the last 18 months or so.
Right, where it was almost before a utility function, now it is a core part to
right.
Sort of managing that cash. Okay, so to your origins, to the equities market, so you're a huge player there. Futures, options primarily. Everybody knows the S&P minis. I look at it on my phone every night to see what's happening overnight. So what is the focus there? That's such a big story for CME now. Is there room to grow? And then what are those markets? What is the data telling you? What's happening? What's going to come next?
Certainly, when we look at the equity markets, I think what's interesting in 2023 is we have seen volatility in the equity markets come off significantly. If we think about trading in the implied levels in the high 20s last year to the teens this year, with even some single-digit realized volatility days this year in the S&P. But the volume and the velocity has not necessarily slowed down in these markets. And I think that's because when we look at how equities are impacted by things like interest rates, whether you're thinking about forward value of dividends, corporate earnings, the tension between employment, inflation, and GDP growth, all of these things also play out in the equity market as a second order or sometimes a first order impact. So when we think about the risk management, certainly equity futures remain the primary access vehicle often out trading the cash markets, the ETFs. It's the product of choice for most professional and retail traders. But when you look at the options at CME, options on futures are also continuing to grow, because when you think about some of these macro environments or the interest rate policy or even some of the uncertainty we're seeing now being forecasted for 2024, people are using options more precisely to hedge those risks. So when we look at the equity options on S&P 500, for example, we've had successive monthly records in August, September, and October. I think last month did almost 1.8 or a little over 1.8 million contracts for the S&P options, just under 2 million for all index options at CME. And look, a few years ago, we were doing sub a million, right? So that growth in options really speaks to that wanting to be more precise about managing your risk further out the curve, or conversely, being more opportunistic with your trading strategy using options, as you're seeing some of this intraday movement settle down a little bit, but you may pick your points either further out the curve as a function of interest rates or certain events, whether it's FOMC meetings, earnings season. All of these things are sort of manifesting, and goes back to my earlier comments. The risk in this market and the uncertainty is only increasing. So here we are in 2023, and I feel like the story the last few years in the equity markets has been, there's no way this year can be crazier than last. Yeah. And then all of a sudden this year happens and you're like, here we go again, right? So I think it feels like ever since 2018, the next year has been one-upping the previous year. And I think that just reminds folks, index choice matters. So you look at some of the divergence of the index performance between the S&P, the NASDAQ, the Russell 2000. You can't sort of you can't be kind of lazy and just use the S&P 500 these days anymore either. You have to be very precise. People are using that sort of index choice matters approach. And that's the great thing about CME, is we have most of the global equity index benchmarks trading here at CME with all of the margin offsets, that capital efficiency. So it's a great way for clients to either hedge their risk or access the markets here for equities.
Well, that's another fascinating point that really has come into focus the last few years, is it's not just the products themselves and how they're used, but the data that comes out of how those products are trading and being used to predict, will the Fed make a move, what will volatility look like in a week, in a month, in a year? Right? It's a whole interesting sort of offshoot of the CME trading business, is that data and what it tells the market.
The informational value of data is only increasing, as is, I think, people's thirst for that data, right? It's almost insatiable, right, when you think about it. But if you look at things like the CME Fed Watch tool, that is certainly highly informative and predictive to an extent of where we think the Fed policy is going to move.
The Fed, I'm sure, is watching the Fed Watch tool.
And it's not that foreign of a concept that you could derive that probability from futures trading. Or could you look at, say, in the equity market, could you look at put-call ratios for maybe directional, where is that market clearing, sort of no pun intended, of what do they think earnings is going to happen, or what event is going to happen today. You can use all these things together just to try and discern that signal, try and discern that informational value, either to be like, do I have the right hedge on? Am I managing my risk appropriately? Or do I disagree with maybe what the market is telling? Or is the market 50-50 and it presents opportunities for people to express that view? And we have various types of products, like you were saying earlier, whether it's swaps, options, futures, cash, micro size, e-mini size, standard size products. So there's really something for everybody when they're trying to digest this information and put that into an operational trading strategy or a risk management program. So lots of tools. And that's where clients are great. They're constantly telling us, this is what we need. Can you do this? Or can we have this data? Can we have this tool? Can we have this product? They're a great source of inspiration for us, and we'll continue to listen to them to see what other data and what other products they need.
So on that note, new products, the other end of the maturity spectrum, last but not least, is crypto. So you have Bitcoin futures, there's talk of Ethereum. It has come out through our research that for many, especially US investors, futures are the only way they can play in the Bitcoin space, right? Because they're nervous about what the SEC might do next. So FTX is behind us for the most part. Where do you see the market going? Is it here to stay? And what's the growth story?
It may be hard to say which assets in the cryptocurrency space or digital asset space might be around forever, but certainly as an asset class, it is here to stay, is our view. It is something, that story has been around for a long time. We've been involved in crypto since 2015 when we introduced the Bitcoin reference rate. We introduced Bitcoin futures in 2017.
It was that long ago.
Yeah, wow. It seems like yesterday and a long time ago, all in one.
Amazing.
It was an exciting time at the exchange, and then just recently it has been reported in the news, we've even taken over Binance to be the #1 Bitcoin futures exchange, including the crypto native products like perpetuals and things like that. And that speaks to our commitment to be the regulated venue, offering regulated products in that trusted, transparent manner. That is to your point, Kevin, where specifically the institutional investor class wants that commitment from CME. They want to trade on CME where there's that high degree of trust as they look to either access or manage risk around something still relatively as new and nuanced as Bitcoin and cryptocurrency. We just had our top open interest day in Bitcoin and Ether just this past week, where Bitcoin about $4.5 billion of open interest, Ether a little under 100 million. There's talk, a little under 1 billion for Ether. We have futures-based ETFs in the US. So this ecosystem is also growing up around the futures at CME, which I think is also an important thing for investors and participants to watch, because unlike other parts of the financial ecosystem or financial services, you typically had the wholesale market develop first, and then it was figured out how to push the individual investor. Crypto is almost happening the opposite, where it really started with individuals and sort of this upwelling of enthusiasm for this new asset class. And now the wholesale community is trying to figure out how do they offer those products in the same way that they do for other asset classes. And that's what's great about the futures. It's a fully regulated product, CFTC approved for trading. It can be used to underline structured products, ETFs, NDFs, swaps, all of these things that folks are trying to figure out how to trade cryptocurrency, and CME futures are certainly at the center of them trying to figure that out.
Yeah, for sure. And that's it. So interesting, sort of to bring it full circle. You're right. Like that retail drive has been certainly unique, and I think the positive after effects of the meme stock craze and sort of Robinhood and their peers has really allowed a lot of institutional tech and products to find their way to the retail audience, right, in a way that the retail investor can ultimately benefit that they couldn't before, right? Everything from tech, data, products. So it really has been an amazing couple of years and a great transition.
Yeah, absolutely. And the way we think about it here at CME is when you think about some of the backdrop of the meme stock craze, the FANG stocks, the pandemic, right? The at-home trader, is I think cryptocurrency is having sort of its moment where it's going from trying to reconcile what has largely been speculative-driven trading, especially when you think about the non-top tokens and coins, to now it's like people are really honing in on what is the use case, what is the fundamental utility this protocol is providing to the marketplace, how can it be used for further innovation. That's why it's not surprising that you still see the predominant trading around Bitcoin and Ether, because that's where that utility and use case is the strongest, regardless of how much fun or not so much fun people have had trading the other ones.
Fair enough. And then if we then, real world assets, if we can put bonds or even equity or private equity sort of on that, in that blockchain environment, there's a lot of very active projects still going there, so we'll see where it all leads.
It really comes down to when you're thinking about tokenizing more traditional markets, I think it's about continuing to remove frictions and increase efficiencies, which is what we've done at CME here for now almost 2 centuries. Focusing on improving and unlocking capital efficiencies, removing barriers to risk management, and increasing the speed at which people can move that risk, transfer that risk, and the associated movement of value. Those are all things that have been tremendously helpful in unlocking potential for the marketplace. And certainly the idea of tokenizing or on-chain activity, I think, is just the next chapter in that same story.
So an easy one to wrap us up. So obviously you have to cover effectively the whole capital markets. You have to stay on top of all the trends, all the products, all the regulations. What do you read, listen to, watch? Like, how do you keep up sort of on a day-to-day basis?
Certainly less sleep these days, right? But joking aside, it's really our clients. Our clients are a tremendous source of information and inspiration. They're a great source of what's going on with their end clients, what's going on with the marketplace. And our vantage point, like I was talking about earlier, sort of being the operator of the market versus just a participant, we have the benefit of this diversified inbound views from all of our different client segments, the different client bases. And it's really, we listen to them. The secret sauce for our innovation has been solving their problems and working with them to increase their risk management capabilities and really leaning into that, creative, customer-driven sense of innovation. That's my primary source of sort of intel of what the market cares about, because you're hearing it from them directly. Sure, you can read online, read newspapers and conversations and whatnot, but really that client information and interaction to me is sacrosanct for figuring out where we should be focused next, because that's where our clients are focused.
That must be fascinating. I'm sure you're talking to broker-dealers, FCMs, investors, hedge funds, operations, front office. Like every day, I suspect your calendar's full of those.
That's right. When you think about sort of the spectrum of clients that we interact with, not only the ones you mentioned, but you also think about asset managers, commercial growers, cryptocurrency traders, fintech startups, like all these folks that we're talking to, you really get a sense of that sort of conjoint analysis of what is mattering to the market right now. And I think that's a unique position of CME, given the breadth of coverage we have and the investment that we've made in these client relationships over the years. They're a tremendous source of information, and I'll certainly be looking to them for the years coming to see what comes next for CME.
Good. Well, we're excited to see what comes next for you and for CME as well. And thanks so much to you for listening. Thanks so much.